Thank you, Tony. All right, good deal. I think our final registration number is like 42, so we're excited about that.
Excellent.
Yeah, that's good. Very good. We snuck in the expert, Mr. Frank Constable, so that's good. Did we decide, David, you're going first, right?
Yeah, we just made that decision about 7 minutes ago.
No problem. I was trying to squeeze as much time as I could out of the morning. So my 30-minute meeting at 10:30 went till 11:30, but we got a lot done. It was great. So no complaints there. So it was good. Uh that's good. That's good. Get everybody rolling in. We get started sooner too because we don't have a sponsor, which is good. Normally every other one of these we do is a lunch and learn, and we actually have Jimmy John sandwiches shipped to wherever people are watching.
Very cool.
And there's usually a sponsor that helps us with those. So we don't have that today, but so that'll help out a little bit. Let everybody get on. So that's good. Tina, where are you based out of Chicago?
I am not. I live and based out of Philadelphia.
Ah,
Yeah, Chicago's my territory, though. I'm there quite a bit.
you born and raised in Philly?
No, Columbus, Ohio. I'm a Buckeye.
Ah, okay. Buckeye
Yeah,
graduate.
I am.
There you go. There you go. Yeah, you guys hold on to that forever.
Oh, yeah, no doubt. I'm hated around here, but I wear my paraphernalia with pride.
There you go. What's the big college out of Philly?
Penn.
Oh, Penn State.
Yeah. Well, no, University of Penn. Penn State's a few hours away from here.
Got it.
But Temple, Drexel, University of Pennsylvania is probably the largest.
Got it. So does that make you a Browns fan?
So Columbus is sort of all Buckeyes. You'll see a lot of Steelers fans, strangely, in Columbus, but it's otherwise splits between the Bengals and Browns because we're kind of right in the middle there.
There you go. Well, I don't have a problem with that Steelers love.
Oh, there you go. Well,
Don't
I'm a
have a-
Justin Fields fan, so now I'm a Steelers fan.
There you go. There you go. So yeah, it'll be interesting dynamic. So getting him going. So
I know.
all right, so we're going to get started with introductions for those of us that are here. We are super excited to present this. I know David and I know what he does and how his system works, and heard David speak. We were a networking group for a long time, and honestly, his services are invaluable for investors who are trying to save money. At the same time, we have a good relationship with title company, Old Republic, and they mentioned to us that they have this awesome speaker who would gladly come out here and talk to us about 1031 exchanges, also known as Starker exchanges. Since both of these things are just really incredible tax strategies between Dave and cost segregation and Tina talking about 1031s, we thought we'd make this available to you guys, our real estate agents who obviously may be investors themselves, or if you're working with investors, we're going to introduce to you guys a couple strategies that didn't put that on do not disturb. Introduce you guys a couple strategies that will help save your investors money, will actually make you guys look even smarter when it comes to working with investors. And with that, we also, because we are dealing with taxes, we did invite my own accountant, Frank Constable, here. So if we have a tax question that's outside of segregation or outside of the 1031 exchange, Frank's going to be helping us out with that. So with that being said, we're going to kick things over to David Mitchell. And David, I know you wanted to start with a little bit about you, the company, and then tell us how cost segregation can help save our investors, our real estate investors, lots of money.
Absolutely. Thanks for inviting me to this group, Rich. I'm really looking forward to explaining, and really my goal today is just to open some eyes as to a often overlooked tax strategy for real estate investors called cost segregation. Let me share this and
That's
make sure
perfect.
that everyone can see it.
We can definitely see it. I do want to interrupt briefly, David, just to let everybody know they've got a couple places to interact with us and ask questions. One of the places is going to be in the webinar chat. There's a Q&A box you gladly can use. What I'll do is field those questions, serve them over to the speakers, and we actually do have some questions that were written ahead of time that, David, when you're done, I'll go through these and let you know which ones apply to your end, and we'll go from there. So again, just want to remind everybody they can interact and ask questions in the chat and the Q&A.
Perfect. So my name is Dave Mitchell. I'm the Director of Client Development with Engineered Tax Services. We are a national leader of specialty tax. We've been doing this for over 20 years, and we're licensed to perform all of the specialty tax work in all 50 states, and we provide audit defense on all of our work as well. A question I always get asked is, are we a CPA firm? No, we're not. We focus specifically on specialty tax incentives. So we're an advisor to hundreds of CPA firms across the country, as well as their clients, but we're not going to take the place of your CPA. So cost segregation is the tax strategy that I'll be going over today. In simple terms, cost segregation deals with the depreciation expenses on an investment property, whether it's a single-family rental house, an Airbnb, commercial building. It doesn't matter. They can all qualify for doing cost segregation. And on the left, you'll see this is what's called straight line depreciation, which is normally what you'd have if you didn't do cost segregation. So the asset or the building is looked at as a whole, and it's divided evenly. The depreciation expenses are divided evenly over either 27 and a half years for a residential building, or 39 years for a commercial building, or a short-term rental residential building. Those are considered 39-year properties. So you take your depreciation amount and it's divided evenly over 27 and a half years. You get a fixed amount each year. By doing cost segregation, you look over on the right-hand side, we go in and do an engineering review of the building, and we itemize out all of the different assets within the building. So flooring, lighting, cabinets, electrical systems, HVAC systems. And by doing that, it allows you to use what's called modified accelerated cost recovery, so maker's method of depreciation. So it's basically just a different depreciation method. The IRS understands that not everything in that building is going to last for 27 and a half or 39 years. You're going to replace the carpeting, you're going to do landscaping work, changing light fixtures, those types of things. So they allow you to speed up the depreciation, or put a different depreciation method in that captures 5-year, 15-year, and then the remaining 27 and a half or 39-year. So we're not changing the depreciation amounts. We're just reallocating the depreciation expenses, breaking them out even further. Again, it's an engineering study that allows you to change your depreciation method. And this has been around since the 1940s, so it's not a new concept. The IRS actually prefers it because it's more detailed. And what we're doing is we're taking, reclassifying real property into personal property. So the personal property would be things, like I said, flooring, cabinets, fixtures. Internal components can get reclassified into 5-year depreciation. And then outside components such as landscaping, awnings, concrete, parking lots, those types of things can be put into a 15-year class life. So why do it? The biggest immediate return is accelerating the depreciation reduces your taxable income. So by having this extra expense write-off up front, you can lower your immediate taxes, which can significantly increase your cash flow. Above and beyond the immediate tax benefits, by doing cost segregation, now that you have all of your assets broken out, rather than looking at it as one asset, you can optimize future write-offs for things like repairs and maintenance. If you do improvements and you're taking out certain assets of the building, you can have those written off immediately, so you're not carrying the old asset and the new asset on your depreciation schedule. I've jumped through a lot. Rich, is there any questions that have come up right
Yeah,
now?
no questions, but I think, from a visualization standpoint, if I've got, and I'm not, let's say it's for round numbers, maybe we'll just call it $1 million property. So for $1 million property, if I'm taking just the normal traditional depreciation schedule, I'm dividing that $1 million by 27 and a half. Is that essentially how that works?
Correct.
Cool. So in essence, to maximize my depreciation write-offs, I'd have to own this property for over 28 years. So, or at least 27 and a half, right?
Correct.
So what you're talking about is a situation where I can kind of take bits and pieces of this property and actually accelerate them. So instead of, I don't know, we'll grab a calculator here and just take $1 million divided by 27. And I guess this is where the divided by 27.5. So my depreciation would roughly be $36,363 a year on this $1 million investment that I made.
Correct.
Now, if I'm utilizing your services, I'm an investor, just bought this building. I'd love to see the write-off sooner. Just as an example, I know it's difficult because we don't know the age of the building and the age of some of the things, but how does utilizing your services increase my deductions on this building from this, in this case, $36,000 a year?
Rich, you're always two steps ahead. I've got a real example where I'll break it out and it'll show a side-by-side comparison in a couple slides.
Perfect. Okay,
But
good.
quick answer is typically about 30%. Obviously, depending on the type of building, a larger building is going to have more assets in it. But typically about 30% can be accelerated into that 5 or 15 year property. So rather
Nice.
than, $20 or $36,000 each year, you could have a $300,000 tax write-off the first year.
No, that's great. So Bonnie did kick in a question before you move on. Bonnie has a great question she put in the Q&A. What is the typical cost for an engineering report to separate all the assets? For example, oops, Tony moved that on me. Thanks, Tony. For example, on a single family rental versus a small commercial building.
Typically it's all based on the scope of the project. So we don't have a fixed fee, but things that come into consideration are the type of building, whether it's a condo, a single family house, a warehouse, office building, the square footage of it, so the size of the building. Typically I'd say between 3,000 and 6,000 or 7,000 is what the typical cost is for doing the cost segregation study. So the upfront cost is, oftentimes insignificant compared to the benefit that you get from the study itself.
Yeah, I would think if you're going from, and again, I probably used an extreme example at $1 million, but you're saying that we can do this on single family and still reap the benefit in that, yes, correct?
Yeah, absolutely.
Okay, and then as a follow-up to that, there's value to doing a single family as well, correct?
Yeah, absolutely. You can do cost segregation on any type of property other than your primary residence. So as long as it shows up on your tax return, whether it's a short-term rental, long-term rental, commercial building, you can do cost segregation and take advantage of the benefits on all those.
And my expense to you for the engineering report is a write-off as well, correct?
Yeah, absolutely.
Perfect. Okay, awesome. Please proceed. I think we're good on questions.
Okay. A concept that was introduced in 2017 with the Tax Cut and Jobs Act was something called bonus depreciation. Basically, this put cost segregation on steroids. What it did is any property that would be reclassified into the 5-year or 15-year buckets would qualify for bonus depreciation. So, like I said, that typical 30% of a complete building, you could take that full 30% deduction in year one. So any building that was placed in service, which means, it was either purchased and then rented, or you were living in it and then you decided to rent it out between the end of September 2017 and the end of 2022, qualified for 100% bonus depreciation. So huge impact for any properties that were purchased or placed in service during that time frame. Unfortunately, it's being phased out 20% each year until it sunsets in 2027. So properties that were purchased in 2023, they can claim 80%. So that means of the 5 and 15-year buckets, you can take 80% of that amount in year one. The remainder is spread out over 5 years, that remaining 20%. In 2024, where we are now, it's 60%, and then it's going to eventually phase out. There's still big benefits in doing cost segregation. Obviously, it's been around since the 1940s, and this bonus appreciation only surfaced in 2017. So there's still a huge benefit to doing cost segregation. This just amplified the results. One other potential piece of positive information is there's a pending tax law right now, the Tax Relief for American Families and Workers Act. It passed the House. Now it's in the Senate. It's a bipartisan legislation, and one of the components of the bill is to retroactively extend bonus depreciation. So they're going to go back to 100% for 2023, 2024, all the way through 2027. So fingers crossed that Congress gets everything done. But that's certainly something that would make it even more attractive. As far
That's
as,
great news.
yeah, we're very hopeful. As far as what types of projects are good candidates for cost segregation, new construction, if you're doing renovations, so you have an existing property and you're doing $50,000 or more, I would say, of renovations, the renovations are a good candidate. Existing properties, so even if you've owned a building for 5-10 years, you can still take advantage of the accelerated depreciation. Everything gets carried forward to the current tax year. Recent or new acquisitions, so a new purchase. If you've got a leasehold improvement, which if you're renting out space, but you're doing the build out on that, the person that's doing the build out can take advantage of cost segregation. A basis step up. So if you've been in a partnership and now you've got full ownership of a building, you can cost segregate the additional pieces, the additional basis that you've taken on. 1031 exchanges go really well together. So when Tina talks about that later, these really complement each other well. And then if you're looking at a large capital gain, there's definitely some strategies to using cost segregation to help limit the amount of capital gain. As I just mentioned, we can do look-back studies. So you can perform a cost segregation study on a prior year purchase and bring that forward, the adjustment to your current tax year. So even if you didn't do cost segregation when you initially bought the house or the condo or the office building, we can go back and bring forward all those benefits and it's still viable 10 years, 15 years down the road from previous purchases. The bonus depreciation rules are calculated based on the purchase or placed in service date. So it's not when you're doing the cost segregation study, it's when you purchased or placed in service the building. So even if you haven't done a cost segregation study on a house that you bought in 2021, you can do it now and still get that 100% bonus depreciation, even though it's a 60% rule for this year. And then what happens, I get this question a lot, is, what happens when I sell the property after I've done cost segregation? So really, in essence, what you're doing is taking an advance on future depreciation expenses. And if you sell the property, there will be some recapture on that accumulated depreciation. This is where I would direct you to work with your CPA and try to minimize that as much as possible. So a couple factors: how long did you hold the property? Cost segregation is not a good fit if you're, flipping a house. If you're buying it, fixing it up and selling it in the same year or within, a little over a year, you're just taking an advance on depreciation that you're going to have to pay back when you sell it. So I wouldn't recommend it for that. If you're going to hold on to the property for 5 years or more, it definitely makes sense. And then the other consideration is, are you going to cash out or are you reinvesting into another property? Most of my clients, when they sell a property, they're usually moving up to a bigger property. They're real estate investors. So in that situation, you can look at doing 1031 exchanges to minimize the capital gains and recapture. And then you can also do a cost segregation on the new property to help offset those capital gains and recapture as well. So it's a strategy that a lot of investors that are buying and selling new properties each year, they take advantage of these to limit the tax liability. Sorry for the blurriness. Your vision hasn't, gone bad. It's just a bad graphic here, but this is an example of one of my clients. They purchased a short-term rental house. So they bought it for $275,000. When you do cost segregation, you have to back out the land value because you can't depreciate land. So the land value is $49,900. So the depreciation basis was $225,000. So if we look here on the left side, this is what our cost segregation results provided. So $106,917 deduction for 2023. You can compare that to straight line depreciation, where if they hadn't done cost segregation, they would have gotten $5,048 the first year for 2023. The reason it's a little lower is it's prorated when you do straight line depreciation based on the purchase date. But you'll see every year thereafter with straight line depreciation, they would have gotten $5,700 in a write-off for depreciation expenses. By doing cost segregation, they got almost $107,000 in the first year. Because this was in 2023, it was 80% bonus depreciation. So that's why you'll see in 2024, 2025, 26, 27, they're still getting more than the remaining 39 years because that extra 20% that wasn't taken in the first year is spread out over the first 5 years. But this was probably about a $3,000 investment for the engineering study, and they were able to write off $106,000 for 2023. So definitely a worthwhile endeavor.
Very nice.
This again is a little blurry. The last one that's blurry. This is part of our engineering report. So this shows the level of detail that we break out each of those assets. So you'll see all of these are 5-year properties. So we've reclassified it from 39 years into a 5-year depreciation cycle. You'll also see like the ceiling fan. We break out not only the fan itself, but what's behind the ceiling, what's behind the walls as far as the wiring, the switches, the conduit. The benefit to having this type of detail is, like I said before, if you do improvements down the road, now you've got numbers to tie to the old assets that you're taking out. So for example, if you look down here, the vinyl plank flooring, 4461 is attributed to depreciation. So if you would have ripped this flooring out, now you can write off the old flooring and get that off of your depreciation schedule. So it's a huge benefit if you're going to be doing improvements down the road. Any questions before I jump into this slide?
Yeah, I might tap Frank on the shoulder, so hopefully he's still around. But so would I see him unmuting himself, so that's good. So would a good candidate, Frank, be, I mean, that's a lot of depreciation to have in 1 year. So if we had a client as a realtor, if we had a client that was selling a property and had a pretty substantial capital gain from that property, and for whatever reason, they did not take Tina's advice and do a 1031. Maybe they just didn't want to. Let's say there was a good capital gain, that depreciation on the other property, let's say they're retaining another property. So we sold one as a realtor, great, we represented you, you made a lot of money, but we also recommended to our client, hey, maybe go do some cost segregation, then you can get a bigger depreciation. So my question really to Frank is, in that scenario, couple 100,000 capital gain, but we utilize David's services to get a big depreciation. Would that help our final tax bill?
Yes, absolutely. Because if you have passive income and passive expenses, we'd be able to net those, and that would help mitigate any tax burden on that. But like you said, yeah, it would be very difficult to have a $200,000 or $300,000 loss without anything to offset it. We'd be able to use those losses and carry them forward. But it'd be even better strategy to create capital gains from selling a real estate passive property. And that would only be for real estate, not selling stocks or anything like that, stocks or bonds. But yeah, that would be a great strategy. And that's where the tax planning comes in play. So you just got to make sure you're talking to your tax professional when you go through some of these things, to make sure you're making good decisions. So.
Yeah. I mean, so again, as an advantage to my agents or agents listening here, if you guys, again, you're selling somebody's rental investment property and they're looking at big capital gains, but they have other properties, it'd be a good idea to give them Dave's contact information, which we will put in the chat. Frank, thank you very much. Appreciate that. Celeste has a question for you, David. It is, if you had a single family home that you were actually living in and then converted it into rental property, she wanted to know, could you do cost segregation on that property?
Yes, absolutely. So I've got a client that we're just doing that. Spoke with him this morning. So he bought the house in 2015, lived in it for 7 years, and started renting it out in 2022. So yeah, that's certainly a candidate.
Perfect. And Ron Picard asks, can real estate broker do their own cost segregation and use this as a basis for depreciation?
It'd be tough because you need to do a full engineering review. One of the benefits of having a company like ETS do it is we provide audit defense. So we're utilizing all of the case law and tax code to be able to break out and segment each individual asset. It'd be challenging.
Okay. Good deal. And let's see here. Best way to save on taxes. Not sure, Raven, if that's a question or not. So best way to save on taxes, real estate investing. I'm not sure if that's a question. So Dave, I'll let you carry on and see if Raven can give me a
last slide here, and then I'll turn it over to Tina. But as Frank was saying, there's a passive versus active income and loss calculation. So generally, limited partnership LLCs, or if you're just putting it on your W-2, it would be a passive investment. So the tax benefits from cost segregation would be treated as a passive loss against the income of that property. They can be carried forward. So if you can't use the full deduction in this year, you can carry it forward. That way it's not a use it or lose it type situation. Speaking to this group, you might be in a position where you can claim real estate professional status. And that's from the IRS standpoint. That doesn't mean you're a real estate professional as far as, you have a real estate license. It means you can claim the rep status based on the designation criteria of performing 750 hours of service in performing more than 50% of your work in real estate, basically materially participating in each rental activity. So this is where I would definitely suggest speaking with your CPA. But if you can attain this real estate professional status, it becomes an active loss on an active investment. So you're able to offset your W-2 or 1099 income with the benefits from cost segregation. The other thing is, if you're filing jointly, your spouse can have real estate professional status, and then you can use that on your own 1099 or W-2 income as well. I've got a lot of clients that their wives or husbands have the real estate professional status, and they spend their time managing the properties and actively looking for new properties, writing off trips to Home Depot for repairs and maintenance, those types of things. And they're able to utilize the benefits of cost segregation on their entire income. So it can be a huge win if you can claim that status.
That's awesome. That's great. That's great savings, certainly for our agents. All right, Dave, I see you've come to the end, so I guess I'll open it up if anybody else has any specific questions relative to cost segregation. Tony has definitely put Dave's contact information up here. So again, as an agent who certainly has rental property, we've potentially created a situation where you can create some write-offs against your own income if you qualify, and give you one more really benefit to your investors who you happen to sell their investment property where they are looking at some pretty big capital gains tax, which, currently there's some proposals out there to even more dramatically increase that capital gain. So cost seg on some other buildings can definitely help that. So David, thank you very much. Hang out in case we get any questions that'll circle back to you through Tina's presentation. And that's perfect. So thank you very much. Great job, by the way.
Thanks, Rich.
With that, we're going to turn it over to Tina. Oh, we never did a name check. Let's see if I could try this. Is it Pashovic? She's muted. Da, da, da.
Okay, Pashovich, that was close enough.
Pashovic. Okay, good. All right, I tried.
Do you see my slide?
Very much so. Very much so.
Okay,
Yeah.
Fantastic.
Yeah. So yeah, I would just introduce Tina. We have working relationships with title companies. Old Republic's amazing. Teresa does some great work for us, and she recommended to me to have Tina on because this is really her lane, and this is something else that you guys can use to help your real estate investors. And with that, I turn it over to Tina.
Thank you so much. My name is Tina Pashovich, and I am the Regional Sales Executive for Old Republic Exchange. We are a direct subsidiary of Old Republic Title, so part of the Old Republic family. And we act as a qualified intermediary for 1031 exchanges. So that's all we do. That's our specialty, 1031 exchanges all day long. And today, I'm going to give you the Cliff Notes version of the basics of a 1031 exchange. So we'll go over the definition and cover the many rules and regulations and talk about the many benefits, not only to real estate investors, but realtors as well. So let's go ahead and get started. All right, what is a 1031 exchange? Well, it's simply the code designated by the IRS, code 1031. that permits a taxpayer to sell property and defer payment of any capital gains tax if that taxpayer uses the proceeds to acquire like-kind replacement property. So a couple of terms to pay attention to. First of all, the taxpayer is deferring payment of capital gains tax, kicking the can down the road, so to speak. But you will see that there are substantial benefits to that tax deferment. And then the other term we're going to talk about in more detail later, like kind. Essentially, we are referring to any type of real property held for investment purposes. Back in 2017, prior to those tax changes, you were able to exchange certain personal property, for example, airplanes that you use for business or farm equipment. However, that was eliminated again in 2017. So we are referring to any type of real property. Specifically, the code states that no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if such property is exchanged solely for property of like kind, again, which is to be held either for productive use in a trade or business or for investment. Exchanges have been around since about 100 years, over 100 years. So it's not a newfangled type of rule. However, we do have the 1991 Treasury regulations that were issued by the IRS that are the foundation of the exchange rules currently. In order to qualify for this tax treatment, the IRS requires that specific rules be followed. And one of the most important rules of the QI is to set that exchanger up for a successful exchange and be sure that you are aware of all the proper guidelines and the rules and regulations. I always like to mention that oftentimes when you hear of a tax break, oh, this just must be for that wealthy real estate investor or that top 1%. In fact, 1/3 of all 1031 exchanges are for properties less than $500,000. And I see on a weekly basis exchanges for properties less than $100,000. So you can still have significant capital gain if you sell property for $80,000. So again, this is a handy tool utilized by taxpayers at all levels. Why do a 1031 exchange? First and foremost, capital gains tax can be substantial. It can often be a shocking number. I get a lot of calls from taxpayers who see what their tax ramification would be if they were to just outright sell their property. And again, sometimes it's an unbelievable number. You have to start with your federal capital gains tax rate, which is typically 15% or 20%, depending on your income. Then you're going to tack on your state capital gains tax rate, and that varies. Illinois, I believe, is 14.95%. If you're lucky enough to live in Texas, that's 0%. Unlucky enough to live in California, you have to add an additional 13.3%. If you were to sell and not utilize an exchange, you're going to have to pay that 25% on any depreciation recapture. And again, depending on your income, you may have to add an additional 3.8% for the Medicare surtax. So you can see this is a pretty, or it can be a pretty significant percentage. So rather than paying Uncle Sam, you can use your own money in essence, if you're interested in purchasing other investment properties. So it allows you the ability to leverage those dollars, leverage your own money in essence, into perhaps a more expensive property or multiple properties. So you are able to build that real estate portfolio and possibly real estate wealth. Another benefit, you could transfer to an income producing property. An example of this, perhaps an investor owns vacant land or maybe a single family home. Well, you could exchange that for an apartment complex or maybe a duplex to generate more rental income. It also allows the taxpayer the ability to diversify and minimize risk to that real estate portfolio. Examples here, you can invest in residential real estate, commercial real estate. Also, anywhere in the United States is considered like kind. And to be specific, anywhere in the United States and 2 territories, which happen to be Guam and the US Virgin Islands. But essentially, again, you can invest in different classes of real estate and also anywhere geographically in the United States. Some of the terms you'll hear throughout the presentation: the relinquished property, or RQ, that's the property being sold in the exchange; the replacement property, or RP, the property being acquired. We're going to talk about the identification period. That's the 45-day period following close of the sale of that relinquished property, in which the taxpayer is required to list in writing possible replacement properties. We're going to talk about the exchange period. That is the full 180-day period following close of the sale of that relinquished property, in which you must complete the purchase of your replacement property. And we'll touch upon the G6 restrictions. That is the specific section of the regulations that state when an exchanger is entitled to receive proceeds. One of the critical functions of a qualified intermediary is to hold and control the funds so that the taxpayer does not have access or touch the money, making the literal exchange of properties possible. So the QI, or qualified intermediary, is that necessary middleman in the process of exchanging properties. What are the rules in a 1031 exchange? Rule number 1, the property being sold and purchased must be held for investment. Primary residences do not qualify. There is the primary resident exclusion 121, where you can exclude up to $250,000 if you're filing single, and then up to $500,000 if you're filing as married. However, exchanges are only for investment properties. You must use the services of a qualified intermediary. And again, that's what we do. All we do, that's our specialty. We create what is referred to as safe harbor. You cannot hire your attorney or CPA to handle your 1031 exchange, because they are in essence an agent of the exchanger. Therefore, it's best to use the services of that qualified intermediary. That's their specialty. They're going to focus on your exchange, and they provide that safe harbor. Rule number 3, the exchanger may not have actual or constructive receipt of the exchange proceeds during the exchange period. Let's say I sold an investment property. It closed. It was not even an in-person closing. I just simply signed some documents. The check is laying on the title agent's desk. I certainly haven't cashed it, haven't even laid eyes on it. Well, let's say I have a sleepless night. I realize that morning, I really do want to invest in another investment property and defer my capital gains tax. Well, at that point, it is too late, because again, I have access to that money. Therefore, number 4 is critical in an exchange. The exchange agreement must be entered into on or before the closing date of the relinquished property. Essentially, the exchange has to be set up prior to closing. We prefer a 48-hour notice. However, it's not out of the question for us to get a call from the closing table, and more often than not, we can get the documents set up fairly quickly. But again, the key is before title transfers or any funds move, that exchange has to be set up, that agreement has to be out and signed, etc. Rule number 5, the taxpayer must identify in writing possible properties that will be the replacement property in the exchange. That identification must be done within 45 days of the closing of that relinquished property. Rule number 6, the taxpayer must complete the purchase of the properly identified replacement property or properties within 180 days of the closing of that relinquished property. So I'm going to back up here. Oh, no, I'm not. The identification, or I'm sorry, these timelines are very, very strict. That 45-day identification timeline, these are calendar days, so weekends and holidays count. Same with that 180th day. So if you happen to be closing on a weekend or holiday, and that's your 180th day, you have to be aware of that and close prior to that. And a good QI is going to make you aware of those dates and send reminders as well. Rules of identification. The 3 property rule perhaps is the most utilized. This is where you are permitted to identify up to 3 properties regardless of their values. And you can end up acquiring 1, 2, or all 3 of them. This is a good option if perhaps your end game really is to exchange for 1 property, but you identify more than one, so you have a few backup options. The 200% rule, you can identify any number of properties as long as the combined fair market values do not exceed 200% of the value of that relinquished property. So I'll keep the math easy. If I'm selling for $100,000, I can identify any number of properties as long as those combined values do not exceed $200,000. And this is a good time to mention the equal or greater concept in the 1031 exchange. In order to defer 100% of your capital gains tax, you want to reinvest all of your proceeds into a property or properties equal or greater in value to the sales price of the property you're selling. So if I'm selling for $100,000, I want to purchase for at least $100,000. If I were to find a property that I really love for $90,000, you're going to pay the tax on that difference. That's a partial exchange. When we set up an exchange, we send out identification documents. We ask you to select either the 3 property rule or the 200% rule. The 95% exception occurs when you have not identified a rule. This is where you can identify any number of properties without regard to value, provided that 95% of the value of those identified properties are acquired. And this is simply just too aggressive and very much prone to failure. Imagine you've identified 6 or 7 properties. You'd have to be fairly confident that you are able to close on all of those properties. So again, 3 property rule, 200% rule, you select one of those and you send that into your qualified intermediary prior to that 45-day identification deadline. Let's take a quick look at that timeline. You have 0 days, close of the first relinquished property. If you're selling more than 1 property and you want to combine those into 1 exchange, you can certainly do that. But keep in mind the clock starts ticking at the close of the very first property. You then have that 45-day window to provide written identification of possible replacement properties and a total of 180 days to close. If you're purchasing more than 1 property, you can certainly do that within those rules we discussed. However, they all must close within that 180-day exchange period. And again, weekends and holidays count. So that first 45 days is probably the most challenging to an exchanger because, again, 45 days isn't that long. However, you can start looking for properties before you close on your relinquished property. You just want to make sure that you don't close on any replacement properties prior to the relinquished property. IRS very strict with these timelines. If you're closing on September 12th, that calculation begins the very next day. Same with the 180th day. And again, if your 108th day happens to fall on a weekend or holiday, you need to close prior to that. There are 4 methods of exchanging. The first, most common, is your standard delayed exchange. That's where you're selling your relinquished property and then closing on the replacement property within that 180-day exchange period. The simultaneous, that's where the sale and purchase happen the same day, and that's possible as long as that relinquished property technically closes first and then the replacement property. With a delayed or simultaneous exchange, the contracts are simply assigned to the qualified intermediary. The reason I mention this is it's in stark contrast to a reverse or improvement exchange, and I'll talk about why here shortly. A typical fee for a delayed or simultaneous exchange is going to run anywhere between $1,500 and $2,200. On contrast, a reverse exchange is exactly as it suggests. It's in reverse order. The purchase of that replacement property occurs before the sale of the relinquished property. Same timelines are in play. This is a good option if you have a property you really, really don't want to miss out on, or perhaps you're obligated, you are under agreement. In this case, the qualified intermediary forms an exchange accommodation title holder and holds title to one of the properties in the exchange. Because of this, it's, again, much more complex. There's more risk involved. our fees, and this is pretty standard, start at $8,500, and there will be multiple closing costs as well. Having said that, if you look at your capital gains tax, it's still, may be worth your while to utilize a reverse exchange. The other type of exchange is that improvement exchange. This is where you're.
Hey, Tina,
Yep.
can I go back to the reverse exchange?
You sure can.
So, I mean, typically so they're essentially funding 100% of the purchase, regardless of the proceeds from the sale, correct?
Yes, and you can
Okay.
use a lender as well. A lender, has to agree to our terms basically, but yes.
So then on the flip side of that, so they've fronted the purchase, whatever the heck that is.
Right.
On the flip side of that, then they would potentially get the right to take the proceeds from the sale to replenish their funds that they put into
Yes,
the new one. Okay.
that's exactly how it works. Good
Okay.
question.
So they just have to be able to have the financial wherewithal to be able to buy this property regardless of the sale.
Exactly.
Okay.
They have
Fair
to
enough.
fund it. The QI does not fund it. And that's a
Perfect. Yep.
question I get often. Yes.
Okay.
All right. The construction or improvement exchange. This is where you're selling that relinquished property, and the QI jumps in, holds title to that replacement property while capital improvements are being constructed. This goes back to that equal or greater concept. Let's say I'm selling a property for $500,000 and I find a property for $250,000 that needs capital improvements. Well, I can use those excess funds, $250,000 or more, for capital improvements, but only under the construct of an improvement exchange. So the QI again creates that exchange accommodation title holder, holds title to the replacement property. The taxpayer or exchanger has access to the property. They are essentially the manager, and they will send the contractor's invoices directly to the QI, and then the QI pays the contractor directly. Again, this is so that the taxpayer does not touch any of the funds during the exchange. Same timelines are in play. So you're closing on that relinquished property. You have 45 days to identify your replacement property and the improvements, and then a total of 180 days to take title, to have all of those identified improvements completed. Improvement exchange, again, since the QI is holding title, there's much more work involved, much more complex. They are $9,500. And again, there'll be multiple closings. What are we talking about when we talk about like kind? I'm often asked, do I have to exchange an apartment building for an apartment building or raw land for raw land? And that's just simply not the case. Any type of real property that is held for investment qualifies. So you could exchange a single family, as long as it's not that primary residence, for a multifamily, vacant land for a strip mall. Perhaps you want to change up your business, hotel for a farm even. So again, the physical characteristics do not need to be identical. You can invest in residential, exchange for commercial. And again, like kind is anywhere in the United States and those two territories, US Virgin Islands and Guam. But again, like kind, very broad and liberal term.
Hey, Tina, I want to, we got a question
Sure.
that was sent in ahead of time from Jessica. And this is kind of a good segue based on the slide that you just had up. Jessica said, do you have to already be renting out your property to utilize the 1031 exchange? For example, she had purchased a property and rehabbed it, but she's had the property since 2018. She just actually did the rehab in 2023, 2024. And am I able to use a 1031? So I kind of read this as she bought it and was just kind of sitting on it, didn't really get it rehabbed ready to rent until 23, 24. And now she's thinking, well, hey, with the value that I can get out here, maybe I'll just take it and do the 1031. So the question really, because I know in the previous slide you had, hey, I can do land for another piece of property. You're really not claiming any income off of land. If she designated this single family as an investment property, but she's not claiming any income off of it, can she still use it as in a 1031?
Excellent question. And as a qualified intermediary, we're not permitted to give tax advice, so we always recommend a consultation with a CPA. Having
Okay.
said that, the IRS looks at your intent at the time you acquired the property. So in 2018, what was your intent? Was it to rent it out? Was it to appreciate in value? You don't always have to rent out a property. Having said that, flips typically do not qualify. You're holding them for sale primarily, right? Less than a year.
Sure.
So you have to look at the whole picture. In this example, you've owned it for several years. I would ask what was the intent, and when you were, rehabbing it, again, was your intent to sell right after, etc. So it's not a straightforward answer. In this case, I would lean towards saying that it probably would qualify, but again, definitely one of those situations where you want to touch base with your CPA.
Perfect. Perfect. Yeah, I think that answers her question. And Jessica, if I didn't, let me know. I do have a question that popped up in the Q&A. Let me open that. Oh, Jessica said I nailed it. Okay, good. It was just vacant. So we got her question answered. So that's awesome.
All right, fantastic.
Yep. Yeah, she followed it up. I was gonna fix it and rent it, but her situation changed. Perfect.
Understood. Okay. Property excluded from 1031 exchange tax treatment. Any stock in trade or other property held primarily for sale. Flips, again, flips are held primarily for sale. You're getting in there, your intent is to fix it up very quickly and get it back out onto the market. So flips do not qualify. Another, like dealer lots, for example, are held primarily for sale, so they do not qualify. Any bonds or notes or any sort of security or evidences of indebtedness or interest against the property. Interest in partnership. Partnerships can exchange. So ABC partnership can sell, ABC partnership can acquire the replacement property. But problems arise when maybe one of the partners wants to cash out. So in this case, there are strategies to use, again, in consultation with your CPA. You can drop out of that partnership into a tenant in common title, and each person or individual at that point can do what they wish with their percentage. However, you want to do that as far in advance of an exchange as possible. There's a lot of gray area with how long you must own a property for it to qualify as an investment property. Many CPAs recommend a minimum 1 year, 1 day holding period. But again, the IRS looks at your intent. If you have a history of flipping, for example, that's not going to bode well. But again, with this dropping out into a tenant in common, if you can do that, a year prior to the exchange, that's best case scenario. Having said that, we've had, many partnerships that have dropped out weeks before the exchange, and we simply send out an audit disclosure. And that hopefully you've consulted with your CPA, et cetera. And Frank or Dave could probably talk more about this and the risk involved. However, partnerships can exchange, but there's potential issues when you drop out of that partnership. Any certificates of trust or any beneficial interest, there's an action against your property, you certainly can't use an exchange. And again, personal property does not qualify since 2010. So no longer can you exchange your airplane that you used for work or any farm equipment. Let's talk about, yep.
Sorry, I've got a question
Sure.
here from Denidra. So just to confirm, there's no way to make money with a 1031 exchange. The main purpose is to save on taxes. I'm going to say yes, based on your teaching. You'll confirm that?
You can save money. You're deferring your capital gains tax. So you're essentially using your own money, or I would say you're giving yourself a free loan, right? And with that free loan, you're able to purchase more expensive property or multiple properties. So you're leveraging those dollars to build and essentially make money.
Perfect. And then of course it's investment property only. We can confirm that's a fact. So
correct.
Right, good.
Correct.
Good. All right. So thank you, Denidra. Appreciate the question. And Tina, you're next.
All right. Potential hazards. I know we don't have a lot of time, but I do want to touch upon these. There's the same taxpayer rule in a 1031 exchange. So vesting is critical to successful exchange. If Joe Smith is on title and selling a relinquished property, then only Joe Smith can acquire the replacement property. Problems might arise if Joe Smith was single when he acquired his relinquished property. He is now married and wants to add his wife to title on that replacement property. Well, the IRS could look at this as a 50% gift. Anytime we set up an exchange, we ask for a copy of the title commitment to verify vesting to set you up for a successful exchange. Again, partnerships can exchange, ABC can sell, and then ABC must acquire. We talked about that drop and swap strategy for partnerships that do not wish to move forward together. Any carryback financing, if the buyer is providing any sort of financing in forms of a note, if you want that money deferred as part of your 1031 exchange, there are specific ways of handling that note. It has to be written in the name of the qualified intermediary, and it has to be paid back within that exchange period. Any repair work. Anytime we look at a settlement statement and we see money going towards repairs, we always suggest bringing outside funds for that, because that would be deemed taxable. That's not exchanging property for property. So again, repair work. Related party exchanges. I mentioned earlier, there's really no set holding period that the IRS states or stipulates. You don't have to own a property for said number of years, etc. They look at your intent. However, with related parties, there is a 2-year holding requirement. If my mother has an investment property and I want to buy that as an investment property, I can do that. I'm going to have to hold on to that property for a minimum of 2 years. And then my mother is going to have to use an exchange into another investment property, hold on to her property for a minimum of 2 years. And the IRS enacted these rules so that family members won't shift their basis or sell property for less than it's worth, et cetera. So, and these are highly scrutinized. You'll be directly asked, did you exchange with a related party? Who is that related party? What is their social security number? And if either one in the party does not hold on to their respective properties for 2 years, both exchanges can fail. Any non-exchange related costs, so prorated rents is a biggie here. If we see those on the settlement statement, we're going to recommend that you handle that outside of the exchange. And then that pesky holding requirement, again, the IRS does not say to qualify for a 1031 exchange, you have to own a property for said number of years. Having said that, depending on your tax history, your intent, you'll hear a lot of CPAs recommend a 1 to 2 year holding period, again, depending on your circumstances. So in conclusion, the benefits of a 1031 exchange, you're deferring capital gains tax. So you're kicking the can down the road, but there are substantial benefits to that tax deferment. Again, you're giving yourself a free loan in essence. So use that money to leverage for wealth building. So you can purchase multiple properties or more expensive properties. And there's no limit to the number of times you can exchange. You can just keep going and keep going and going. You can relocate your assets into different classes, so residential or commercial, and again, anywhere in the United States. And it's also a great estate tax planning tool. I'll use my mother as an example again. If she has an investment property, passes away, and I'm the heir to that property, I receive it on a stepped-up basis. So at that point, if I were to sell right away, I would not have to pay capital gains tax. If I hold on to it for 5 years, then I'm paying the taxes on those 5 years only. What does a qualified intermediary do? Well, it is required by the Treasury. We acquire that relinquished property from the exchanger and transfer it to the buyer. Same with that replacement property. We prepare all the documents. This includes the agreement, the assignments of the sales and replacement property contracts. We consult with the exchanger's tax advisor if requested. Again, we're not permitted or qualified to give tax advice. We do provide general guidance, and we can do basic balancing of the equities. Other than that, it's always wise to touch base with your CPA. We execute the closing documents as principal. And critical function, we hold the exchange proceeds to prevent the exchanger from either actual or constructive receipt of the funds. And we coordinate with closing agents, real estate agents, tax and legal advisors. When selecting a QI, do your due diligence. There is a history of fraud in the industry. So the last thing you want to do is a Google search. You want to find a company tied to a larger bank or a larger title company, for example, and obviously experienced company and a financially secure company. Old Republic Exchange Company, parent company, Old Republic International. This slide is a bit outdated. It has close to, I think it's about $26 billion now in assets. And you want to make sure your QI is bonded and insured and that they can prove it. Old Republic Exchange has a 50 million errors and omissions policy and a 120 million fidelity bond covering acts of dishonesty or fraud. That happens to be the highest in the industry. My
Excellent.
contact information, and yeah, appreciate it.
Excellent. Great job, Tina. That's I know I learned a lot in that. So that's fantastic. So if I can get my panelists back, I got a couple questions that were sent in early, plus some things I got to have. Tina, if you'll give us our screen back, and then if we
sure
can
will.
get Dave and Frank on here as far as that's concerned. So just some basic questions. Perfect. So first of all, I want to make sure I heard what Tina said right. And I'm going to go to Frank for this question. Frank, is the Illinois state capital gains tax, what exactly is, how much, what's that rate?
So Illinois just has a regular tax. There's no differentiation between capital and ordinary, and it's 4.95%.
Okay. All right, good. So it's 4.95. So potentially, from what Tina was talking about, if you're paying the Fed 15 plus the state, we'll just round it. Who cares about the 0.05? So it's 15 plus 5, it's 20%. If you're in the Fed's 20% number, now you're paying 25%, of which you can avoid using a 1031 exchange. So that's perfect. I put this question out to Tina and Dave. I think it's an excellent question. And I know you guys work with real estate agents to solicit these services. So one of the questions Andrew asked is, where are agents going to market these types of buyers? And and I've got some suggestions where they can go online, but you guys work with agents, and Andrew wanted to know really how he can position himself as kind of a subject matter specialist relative to taxes and things like that. What are your thoughts on that for Andrew?
Sure, I'm happy to answer that. As a real estate, as a realtor, you can advertise 1031 exchanges either on your website or your business card. Just establish a relationship with the QI, because you just need to be aware of the very basics, right? And all you have to do is call the qualified intermediary. But anytime you have a client that is selling any type of property that's not their primary residence, it's a good idea to inquire to see if an exchange is worthwhile. And a lot of investors, believe it or not, are not familiar with a 1031 exchange. So you can become the expert again and advertise it. You can get involved with some local real estate investor groups. They're all over. So just attending a few of those is a great idea. I present at many of those clubs, and they seem to be growing in popularity. And I do see a handful of realtors attend those. So that's another good idea to get in front of that investor clientele.
Yeah,
and
I did a Google search, and there's a list of investment clubs all over the Chicagoland area, all over the state of Illinois, quite honestly, that you could easily find a date and a time that works, and it's close to your home or close to your business, and just start going there and meeting some of these folks who are really living and breathing that world. David, what do you got for us?
Yeah, and you can really set yourself apart as a realtor by being a trusted advisor, by bringing some of these concepts to your client. You're really going to look like a hero if you can save them, hundreds of thousands of dollars in taxes potentially on their transactions. So, what I do for a lot of my realtor clients is put together an analysis up front on potential properties, where it'll show what the potential tax benefits are, It'll show what our fees are for the service. So that way they can make a decision, if they're looking at multiple properties, which is the most beneficial from a tax standpoint. Obviously, any type of commercial building, if there's commercial agents, any of those buildings are great candidates for cost segregation. And then for your clients that have rental properties, if they've got 5, 10 different rental properties, we can go back if they haven't done cost segregation in the past. We can do cost segregation studies on all of their properties with a potential huge impact for their taxes going forward. And, if they're at that level where they've got 10 investment properties, they could probably qualify for that real estate professional status pretty easily. So then it's even more lucrative for them to look at some of the tax benefits from cost segregation. But like Rich said, if you can tie into investors, there's a ton. Bigger Pockets is one site online that's got a huge community of investors.
Yeah, there's just a ton of them. And then, I mean, as realtors, you guys are working with buyers who, they're probably not buying again for 7 to 10 years, where investors, they could buy multiple times in 1 year. So, I mean, it's certainly a great resource. I do have a question from Jan that might be more geared towards Frank. I've owned a condo that I use as vacation property, and I have rented it out a few times a year. If that is the only property I own, I may be better off selling it and taking the primary residence benefit. How long do I have to live in the property to consider it my primary residence versus vacation home? Frank, any thoughts on that?
It has to be your primary residence for 2 out of the last 5 years. So she would have to convert it to her primary, live in it for 2 years, and then she could sell it and get the exclusion. Now, one of the things related to that is there is a number of days where it is a rental opposed to being a primary. So we may not get 100% of the exclusion. So it's a complicated formula, because that's what people were doing to take advantage of it in the past, is they would just have a rental move into it. And now the IRS has put out rules where you got to look at the number of days it was a rental and number of days of personal residence to see if there's any, at least, depreciation recapture. So.
Yeah, perfect. Perfect. Well, we're a little over, which we try not to do. So I just want to promote, first of all, thank you very much, Tina. Thank you very much, Frank. Frank was a little bit of a last minute call up, but a phenomenal accountant, very, very well versed. When I ask him questions when it relates to real estate, he doesn't hesitate. So he knows this stuff. He's certainly my guy. Dave's been my guy on the cost seg for a long time. So we do appreciate that a ton. We do have some upcoming events. Next week, we will be doing a class on one-time close. So that is our Lunch and Learn series, and that is one-time close. If you're out there working with a buyer who might be in a little bit higher, mid to higher end, it might be more efficient for you guys to pair them up with one of the builders we'll have on the panel, and then go get a one-time close construction loan. Lots and lots of lots out there, pun intended, and lots might be easier to come by than a single family where you're competing in this market. So that's going to be a great class for us. And then after that, in June, we come back June 13th. And by the way, the OTC class is going to be one-time close class is going to be May 15th. So that's a week from tomorrow. And then in June, we are back with Ask the Appraiser. And so we're going to have an appraiser as our person that you guys can grill with all your good appraisal questions. I know you guys love appraisers, so we brought somebody on. This is going to be somebody new compared to who we've had in the last couple of years. He's local in our market, and looking forward to that. And those are the next 2 events that we'll promote. You guys have some links here in the chat. Thank you guys again for doing this. And the last shout out, of course, by the way, Teresa snuck in. She's our rep from Old Republic. Hello, Teresa. But my last shout out goes to Tony. None of this stuff happens without her. So I thank you very much, Tony, for keeping all this stuff together. Guys, thank you very much. Reach out to these great resources or us and we'll get you guys connected. We'll see you next week on the one-time close program. Take care, guys. Thanks, guys.
Thank you.
Thank you,
Thank
Rich.
you.